Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo, now the video for the 6th of July. Here in 2023, we have the ADP report. What is the ADP report? Usually something that doesn't move markets, but it's a harbinger, perhaps, for the jobs report on Friday. ADP is going to be your change in non-farm payrolls, just ahead of the official monthly non-farm payrolls jobs report, but nonetheless, the ADP report was a barn burner, double the expected value. In other words, the market was looking for about 214 or 215,000 jobs added. No, there was about 497, almost 500,000 jobs added, at least in terms of the ADP change in non-farm payrolls. So that's a good sign, right? The economy's doing great. The jobs are going up. People are being hired. Wonderful news. And the market goes down. And why does the market go down? Jobs are good, right? No bizarro land where good news is bad news, because if the economy's doing well, and the signs are that it is, and the Federal Reserve in their last meeting just told us that they are seeing their projections of the unemployment rate going down, and if unemployment rate goes down, jobs go up. And that's happening about a few weeks after the Fed said that was in their calculation. Why is it concerning to the bulls or the market itself? Because it just about guarantees what we knew to be the case at the end of this month. And that is this: the Fed will raise rates at the end of July, 26th of July, just in a few weeks from now. At the end of the month, the Fed will raise that benchmark rate 5%, 500 here on the Fed Watch tool. Just means it's a 5% Fed funds rate, or they're going to raise that to 5.25. That's what spooked the market. Let's start easy and go to something a little bit more difficult. Here's what's easy. If the Fed's going to raise rates, rates are going to go up. And we'll look at this through TNX, and TNX is your 10-year Treasury Note yield. Not only did it go up today, it was up, roughly speaking, don't look too much at the percentages, but 2.5%. What we do concern ourselves with is the slope of the chart, the velocity of the chart, which is how fast it goes up, and these little horizontal numbers, 40 is indicative of 4%. So when you're looking at the TNX or TYX or other Treasury yield, this is actually 4% on the 10-year Treasury yield. This is 3%. And here is 2%. And underneath all of that, where we spent the bulk of 2021 and some time before that, is 1%. So it is the velocity of which the market, or at least the yield, has moved from 1.5% to 4%. And that occurred, lots of lines on the chart here, but just getting your attention to how quickly interest rates moved up. And they are on the rise, potentially up to the prior high. That's easy. The other side is the bond market going off to lows. We've had a downside target for the bond market. I'm looking at TLT down to this 99, or about the 100 per share level in TLT. That's your 20-year or so bond fund. We can look at IEF, which is going to be similar in terms of a tradable ETF, or you can look at the bonds, which is the 10-year note is ZN, off to new lows and retesting off the target being this level to go from the top of the trading range all the way once again to the lows, and possibly even lower than that. ZB is your 30-year Treasury bond. And that puts a little pressure onto the stock market. This is when rates were going up so rapidly, the economy tipped into a recession. And generally speaking, the technology sector, ignore what happened in 2023, but quickly speaking, in terms of the technology sector and the NASDAQ and the XLK, we had a pretty persistent bear market or downtrend as interest rates were pulled rapidly from about 1% to 4%. And that's concerning for the broader market. Artificial intelligence, some of the leading tech companies are boosting up the NASDAQ, boosting up the XLK. XLK is going to be, looking quickly inside of it, mainly your technology companies: Apple, Microsoft, NVIDIA, Broadcom, Adobe, Cisco, and down the list. What do these companies have in common? They're tech names. A lot of them do have to do with artificial intelligence. There's Apple. Apple's up at, I believe, new 52-week highs, just coming in here. We see other stocks such as NVIDIA up there at the highs, and just taking a look once again at the XLK, where the broader names are Microsoft, NVIDIA, Broadcom, Adobe, and some of the others. So AVGO is Broadcom. It's there as well. And that is pulling or driving the technology sector higher right there with the NASDAQ. If rates keep going up, and they will keep going up, that can put some pressure on those stocks. But it's not all bullish. Let's move away from the tech stuff into the financial stuff. So here is the boom and the bust. Notice that the financial sector XLF is not really recovered and actually is down on the year here in 2023. And that is something to keep a close watch on as interest rates continue creeping higher and bonds continue pushing lower. Outside of that, we'll take a look at industrials. That's the only major sector outside of Y. What is Y? Y is the consumer discretionary. And I say consumer discretionary, but that's not really accurate. Amazon and Tesla fill the biggest spots in the weighting, at least, of the retail sector. And there's lots of other stocks in here, but Amazon and Tesla, just like Apple and Microsoft, fill the biggest spots of the XLK and Y. Industrials, that's more like it. Raytheon, Honeywell, UPS, Caterpillar, and others, Boeing in there as well. In the material sector, Linde, which is actually up there, making 52-week highs as well. But outside of those stocks that have big market caps, or at least growing market caps, you're seeing across the board a little bit more normalcy. So back to the normalcy. APD and all the other stocks in here. E is going to be energy. That's going to be made up of ExxonMobil and Chevron. P is going to be your staples. That's PG, Procter & Gamble, Pepsi, Costco, Coca-Cola, Philip Morris, and the list goes on. V is your healthcare. And finally, U is your utilities. What's the purpose of looking at sectors? It cuts through the fact that a few stocks have held up the market, and the broader market and the broader sectors are actually flat to negative in 2023. Something to keep a close watch on in your trades. So V is healthcare is a flat trading range. U utilities actually is down on the year. P staples, the defensive name, is a little bit flat on the 2023. And of course energy, which is tied to crude. Crude's been going down. Energy stocks and energy sector shares have been going down as well. But it really is tied to the monsters being some of them in technology, some of them in discretionary. Which stocks, speaking of, made new 52-week highs in today's volatile trading session? Well, Microsoft and Charter were the leading ones in today's close, but Meta, which is Facebook, is back in the news with a potential, dare we say, Twitter killer. The media would have us believe that, but we'll see what their interesting new Twitter platform or their Threads platform can do. But nonetheless, headline news is bullish and some buzz is coming into Meta shares. Looking quickly down at its sizzle index, double, sizzle index about 2, and the calls and the volume is heavily bid in that stock today. And again, mainly due to news and some publicity. The trend in Meta is up, and it's a stock that it's the only stock currently that made a new 52-week high. There was one stock, and then today 2 stocks. In today's session, we thought it might be more, but actually Pfizer, in terms of large cap stocks, this is a scan for stocks making 52-week lows. Pfizer is the only stock of note making a 52-week low. And that is on the short or the bear side of a weak stock getting weaker. Stocks that make 52-week lows tend to go on to make additional new 52-week lows, and each of those get us, in terms of short-term trades, on the bear or the short side of a downtrending stock. So that's one of the only ones that will be on the short side, at least from that perspective. We could look at CVS to see a stock that's weak getting weaker as well, and of course other stocks that might be in that same sector. Not all is bullish, and that's one of the themes of today's video. As you're looking at the Fed, you're looking at the ADP, which is your jobs and non-farm payrolls. Tomorrow on the calendar is going to be your retail sales. So before we get there, just as we conclude and get ready to go for the retail sales, let's go back to the retail sales or the non-farm payrolls, called out the employment. There it is, the employment situation. The estimate is for a rise in payrolls of 213,000 for the unemployment rate. The previous is 3.7. To push it down, that's bullish, right? Unemployment goes down. The expectations for a 3.6. Private payrolls, you can see all the data here in the calendar, market watch, and the employment situation. There's other ways you can look at those data. But before the market opens, we'll have these data. Do we have more than expected? Could put another bear move in the market, or anything else that surprises the market could be a little bit more bullish. We'll focus on the jobs report on Friday's session, what that says about the health and continued strength of the economy. And of course, this is your Fed Watch tool, and the chance of a rate hike in January or July 26, 92%. Just about a certainty there. A 7% chance it doesn't happen, but probably will. A couple of weeks to go until then, and the jobs report will give us a little bit better sense of the health of the economy and the state of the jobs market. So we'll see you then. Take care, TheoTrade. Have a good evening, and this is Corey Rosenblum with tonight's Theo video update for July 6th, 2023.